For most investors, the primary danger of holding a single stock is straightforward. It simply won't generate the expected return. Over the past 50 years, academic finance has been on a quest to mathematically eliminate that exact risk. The foundational solution arrived in 1952 with modern portfolio theory. The premise is that by combining 15 to 20 different assets across various sectors, an investor can completely strip away the specific risk tied to any individual company. What remains is only systematic risk, the unavoidable baseline risk of the broader market. To find the optimal mix, analysts plot expected return against standard deviation, or risk. This generates a curved boundary known as the efficient frontier. Portfolios below this curve are inefficient, offering lower returns for identical risk. Any portfolio above the curve is mathematically impossible. This mathematical framework eventually evolved into the efficient market hypothesis and the capital asset pricing model. These theories assume that markets are perfectly efficient and that prices instantly reflect all available public and private information. This chart shows the security market line, a core component of the capital asset pricing model. It calculates a precise expected return by measuring a specific stock's sensitivity to market movements, known as its beta, against a baseline risk-free rate, such as a government bond. These foundational models rely heavily on a single fragile assumption that investors possess a limitless capacity to process information and will always behave as perfectly rational, risk-averse calculators. In reality, actual stock markets experience sudden panics, speculative manias, and bursting bubbles, events that stand completely at odds with perfectly rational pricing models. The early theories struggled in practice because reducing a stock's risk to a single beta measurement could not account for all the diverse macroeconomic forces driving its price. In the late 1970s, analysts responded by developing arbitrage pricing theory. Instead of relying on a single beta, this quantitative approach adopted a complex, multi-factor method to capture price movements. Analysts apply separate risk premiums to a variety of identified macroeconomic factors. A security's expected return is calculated by tracking its specific sensitivity to anticipated changes in inflation, industrial production, or the yield spread between different types of bonds. Modern multi-factor models expand on this framework even further. They decompose returns into specific underlying company characteristics, weighting portfolios based on variables like market size, intrinsic value, and price momentum. Yet, even the most advanced, data-heavy multi-factor models face a strict limitation. They rely purely on quantitative inputs. No matter how many economic variables the algorithms track, they consistently misjudge the market. They fail to account for the psychological and emotional factors driving human investment decisions. To understand why prices deviate from their fundamental values, analysts turn to behavioral finance. This discipline attempts to merge cognitive psychology with conventional economic theory. It starts with the concept of bounded rationality. Even when humans have access to all freely available data, limited time and finite cognitive capacity prevent us from accurately processing every relevant fact. Forced to make decisions under uncertainty, investors rely on heuristics. Instead of objective mathematical evaluation, we take mental shortcuts, search for familiar patterns, and depend heavily on gut feelings. This leads to phenomena like herding. Investors will irrationally follow each other's movements, abandoning fundamental data to chase upward trends, and aggressively inflate speculative bubbles. These biases demonstrate that when placed in complex, high-stress environments, human beings do not seek mathematically optimal solutions. They seek satisfactory, comfortable mental shortcuts. The impact of psychology on pricing becomes clearest through prospect theory, which proves that individuals do not value equivalent financial gains and losses equally. Psychologists Daniel Kahneman and Amos Tversky found experiencing a financial loss is 2.25 times more painful than an identically sized gain. This disproportionate pain creates loss aversion. Investors irrationally hold poorly performing shares to avoid acknowledging a bad decision. At the same time, they frequently sell their winning stocks far too quickly just to lock in the gains. This emotional friction limits how fast stock prices actually adjust to positive or negative news. directly contradicting the instantaneous market efficiency that early theories assumed. Modern portfolio management requires navigating both domains at once: the pristine, quantitative models and the messy, unpredictable psychological realities. To effectively construct a portfolio, an analyst must use the elegant mathematical theories to build the structural framework, but rely on behavioral finance to navigate the irrational human beings actually pushing the buttons.